Hi everyone, welcome to another Heartwood Financial Services Market Update. This is Demel Gonzalez, President of Heartwood Financial Services. You're in for a pretty interesting update. I guess I always say that. They're interesting to me. But there's been a lot going on. This has been a very active month. December was a pretty good one. And I even include a little bit of the goings on from January. So don't miss it. Feel free to share it. I hope you enjoy it. All right, let's get started with the asset class returns. We finished off with a pretty good bang here in December. Here are the numbers for the month and also year to date. So the red is the large cap stocks. You see we were up 3.84%. For the month of December, up 18.4 for the year. Pretty darn good year. I don't think too many people would have thought that with everything we've been through. Small company stocks had a tremendous December. You can see 8.32% for small cap stocks, up 11.29% for the year. Almost all the returns from December. Real estate was a little bit of a laggard. You can see 1.5% for real estate for December, and still actually a little bit negative for the year. Obviously, real estate's been a little tough, especially with retail, hotels, and some of these areas. But that could be one of the areas that could really be set up for a nice rally as the economy improves. So more about that. Developed markets had another good month, 5.5%. Maybe you're starting to notice a little trend reversal. Hint, hint, what I'm going to be talking about. So 5.5 on the developed international, up 11.12 for the year. Emerging markets up 6.09 for the month of December, up 15.51% for the year. Pretty darn good results, actually better than what you saw in large cap. And so that's definitely something to keep an eye out for. On the fixed income was barely up for December, but it still finished off with a pretty good year because it started off really well with the pandemic concerns, up 0.13 and 7.34 for the year. High yield and a lot of high yield related type bonds finished off the year pretty well. Junk bonds or high yield were up 1.24 for the month of December and 11.65 for the year. So did better than actually the high credit quality bonds. Not a lot of people would have guessed that either. And then finally, gold. Gold ended up having a pretty good month for December, and we saw 24.17 for the year. They had been doing pretty good. Had been going down a little bit over the last several months, but finished off pretty good, especially with the talks of stimulus coming back into the foray. So gold likes anytime there's going to be money printing and more dollars. So you can see how they finished off the year pretty well. So overall, pretty good year, and I'll get into a little bit more of the specifics here in the following slides. Thanks. All right, so the market update title is 2020, the 2020 irony, and I'll show you kind of what I mean by that here in a minute. So first of all, I thought this was pretty big. The market had the biggest drawdown, but ended up positive ever in history. Okay, let that sink in. So we were down 30% plus, and we still ended up positive in the same year. That's never happened before. It's never been that bad and gone positive. And so we've had one heck of a roller coaster ride. So I call that the irony of the year, and we'll talk a little bit more. And we've talked about why that is in the past as well. Then we also have the market's hitting a high, juxtapose that to COVID deaths hitting a high. And so a lot of people are a little perplexed by this. And there's a lot of reasons that we've talked about in the past. You got the Fed, you got Congress with stimulus, you got low interest rates that make stock prices go up. Interest rates are like gravity. So lower interest rates, less gravity. So it's been very good for stocks, even in the midst of the worst part of the pandemic. And so obviously the market is looking around the corner saying, we think things are going to get dramatically better. They probably are. And we'll talk more about, is it maybe a little ahead of itself or not? Okay. Right now, we're starting to see mixed results in the leading indicators for the economy. The big one is the jobs number. That comes out once a month. It came out today. It actually showed a job loss for the month of December. So it was a little disappointing. Market was up today though. Okay, so again, the market's kind of already looking past that because COVID vaccines are not a leading indicator that most people follow, over the years. It's not built into many people's models. But the COVID vaccine is a huge leading indicator because shots in arms mean that the economy is going to dramatically improve here soon because it's all been about COVID, right? So leading indicators, some of them are good, but a lot of them actually have been getting a little worse. And then finally, the stimulus has been passed. Finally, it's been passed. We've been waiting for this for months. We're going to get more stimulus checks, more PPP. So there's a lot of help coming. And I don't need to tell you that the runoff in Georgia was a pretty big deal. And now we have a democratically controlled Congress. And with the Congress being blue, that means there's going to be probably even more stimulus coming. And so we've seen the stock market react very favorably to this potential event. Now, even though it hasn't happened, but remember, again, the stock market's looking ahead, right? So that stimulus potential is what's driving the market now. And if it doesn't come, there could be a little bit of a disappointment. But the stimulus, I think, is more of a short-term thing. Long-term, it's going to potentially create other problems. So that's a conversation for another program. But that's essentially what we've been looking at for the last month or so. Okay, the title for the Outlook slide is the 2021 Potential Reversal. Sorry, I didn't make that rhyme. Not very good at rhyming. But you get the point. Last year, we had a tremendous stock market at the end of the day and a tremendously horrible economy. Probably the worst since the Great Depression. And so, am I seeing a 100% reversal of that? No, but I think there's going to be some reversal of that. In other words, we're going to have a much better economy, but a stock market that's not as good. Probably not going to be up 16% in the S&P 500 next year. Now, I'm not saying there's not going to be opportunities, because there's going to be opportunities in other areas, and I'll talk about that in a minute. But the opportunities are certainly not as great as they were last year. Secondly, is the market too expensive? I'll get more into the nitty-gritty on the extended version, but the summary of that is I think the stock market is pricing in a very dramatic improvement in the economy. Probably one of the most dramatic improvements that we've ever had. In 2009, 2010, we had a very dramatic improvement in the economy and earnings. It's almost to that level of how much the market is pricing in for the market to improve. So is it possible? Yes, I think it's possible, but every day the market goes up, it gets a little harder. So every day the market goes up, I get a little bit more where I have to feel like I have to hedge a little bit more. and get a little bit more cautious. Okay? The great rotation, is it happening? We've talked about this for so long, for years. Before, there probably wasn't a big catalyst, but I think now we've seen a pretty big catalyst. COVID and the resulting stimulus and the recovery has created quite a catalyst. So I do believe that we're going to see some rotation into value stocks, small cap stocks, and international stocks. Now, does that mean the winners from the previous few years are going away? The large cap stocks, mostly tech? No, probably not. But relatively speaking, they won't be outperforming like they have. And so the opportunities are in these other areas that have not done quite as well as large cap growth. And finally, shifting portfolio to more cyclical and international stocks while keeping a modest overweight to stocks. And it's modest because of the market starting to get a little expensive and pricing in almost perfection. But the move going more small caps, going more international, going more value is still in the works. In fact, if anything right now, with Congress going blue, going more small cap and going more international makes even more sense. So I'm examining maybe even adding a little bit more to that. But for right now, we continue to do the rebalancing, which is taking a little risk off the table while we do some of the strategic tactical changes within the stocks that you see there. All right? Thanks. Okay, for the educational slide this month, I want to talk about the 60-40 portfolio mix. This is traditionally the retirement mix for a lot of folks. 60% in stocks, 40% in bonds. And does it still work? Okay. I've been reading a lot about this. There's some articles about how 60-40 is dead. And a lot of it is because of the 40 part, the bond part, where yields are so low. And with yields so low, is it still going to do the job it needs? So first of all, let me explain to you what this conversation is all about. You can see here, these are projected returns from Vanguard. And they have the projected returns for the next 10 years. Of course, these are just estimates. But you can see stocks around 7%, international a little higher than domestic. You can see in fixed income in the range of about 2%. Treasury bonds lower than emerging market bonds. Okay? So if we create a portfolio where we have 60% in stocks and 40% in bonds, you know, I like to do the math, so I wanted to write this out, and you add those up, now we're looking at a projected 10-year return, according to Vanguard, of about 5%. 5% is not as high as we used to talk about. 60-40 portfolio has historically, since back in 1929, has historically made about 8.5%, 9%. So the expected returns for the future are definitely lower. Okay, so that's the first message here. Expected returns for the future are probably lower. Maybe not for the next few months, but for the next 10 years. Okay, and so the first question is 5% enough? I think for some people it will be, because you got to remember, if projected returns are low, inflation is also going to be low, and vice versa. Okay, that's usually how it works. So, you know, inflation's around 1.5% right now. So you're still positive, you know, 3.5% after inflation. And that usually does the job for a lot of folks. But if you want to try to squeeze out a little bit more because of the situation we're in, the next question is, well, what do you do, right? What are the solutions? And so there's essentially one of two things, or maybe two things that you could do. One is you could add to the 60%, right? That's in 7% earning stocks. The other is you could take the 2% that you're normally earning in bonds and add a little bit of risk to the bonds and try to get a little bit higher rate of return, like maybe adding more emerging market bonds, maybe adding a little bit more high yield. So you can see there the yields are a little higher. And that might help you bump up that rate from a total return of 5 to maybe 5.5, 6%. All right. And so what I've been doing in the portfolios is I've been doing a little bit of both. I've been adding a little bit more to stocks. Not anything dramatic, but just trying to get a little bit extra by having a little extra stocks, making sure I have dividend paying stocks as part of that equation. And also adding a little bit of those diversifiers in the bond portfolio to get the diversification, of course, but also to get a little bit more yield. I think that makes sense in this environment going forward. The downside with it is it does add a little bit more risk, and that is something that we have to keep a very close eye on and manage. So if you have any questions about this, let me know. I wanted to share this with you. This has been on my mind. And it's definitely a challenge going forward. But, I will do my very best to squeeze every ounce of return without taking too much more risk on your behalf. Please call me if you have any questions, though. Appreciate it. Well, you know me. I always like to end with an inspirational note. This time around, I just wanted to say Happy New Year to everybody. 2020 was a pretty rough year for a lot of people in many ways. And I hope everybody is safe and healthy. And you know that you guys are in my prayers to continue to stay safe and healthy. But I also want to look forward to a new 2021. It's like a blank page. So far, the first few days haven't been so good. I shouldn't laugh about that. It's been pretty serious. But I hope that the rest of 2021 definitely brightens up. I do see a lot of good things in the future, especially with the vaccines being rolled out. So I look forward to seeing you guys in person very, very soon, and miss you all. Take care. I talked about this in the market update, the biggest drawdown but yet positive for the year, the biggest ever. So I wanted to show you the chart on this. You can see the dots here show the drawdowns, okay, the recent one at 34% minus. There it is. And we still ended up positive 16% for the year. Usually when we're down that much, 34%, negative returns, minus 20 negative returns. There was a minus 28 and positive 23, and that happened right as the market was recovering from the great financial crisis. But this one was even worse. Okay, pretty interesting. The other thing you can draw from this chart is that pretty much every year the market has a correction. The average correction, as the chart here denotes, it's about 14%, and it happens quite frequently. So, but that was pretty impressive. Pretty interesting, huh? Okay, I admit this chart does get a little nerdy, so hang in there with me. But I mentioned at the first part of the outlook that maybe there's going to be a reversal where the economy was bad, the market was good, and maybe the economy will be better, but the stock market won't be quite as good. This chart here shows what happens to earnings and what happens to the stock market. Now, it is not unusual to have positive earnings growth and a negative stock market. It's happened a few times before. So you could see, for example, 2011 we had 0% in the stock market and a 15% earnings growth. We've even had 1.5% decrease in the stock market with an 18% earnings growth. And so it's not impossible. Now, I'm not predicting that we're going to have a negative return. I just don't think it's going to be as good as it was this last year. Because this last year we had negative 23% earnings growth and a 16% growth in the stock market. So as you can see, anticipating earnings growth to be good, probably really, really great actually. But the stock market doesn't necessarily have to go up exactly the same way because we've been in what they call multiple expansion for the last few years. And I think next year we might start seeing a little bit of multiple contraction. Okay? Call me if you want to talk more about this. It can get really wonky. Thanks. Okay, so in the market outlook, I talked about the valuation. You know, they're getting a little bit pricey. I'm getting a little bit more concerned about it. And usually when we talk about valuation, you look at price to earnings ratios and things like that and just show you like a historical price to earnings ratio. But what I wanted to do this time is show you a little different approach. I want to show you, this is a chart that comes from Quandl. On their site, they actually show the history of earnings growth. And this is like over the last 30 years or so. And so I wanted to show you right now where we are is we're at about a negative 25% for earnings for 2020. That's a pretty big drop. And so the earnings going forward, the consensus right now is positive 23. So we're going to go from minus 25 to positive 23. And the point that I want to make is that doesn't seem very far-fetched because we've had minus 50 to positive 78 before. And at the worst of the great financial crisis, we were at minus 77 and we went all the way into the 200s. Okay, it's pretty amazing. Now, the point that I wanted to make though is we didn't have as big of an earnings dip. Okay? So this would probably be a little closer to what we saw back here in the early 90s when we were down 25% in earnings. And you can see that when it's not down as much, it doesn't come back as much. And so back here, it was down 25 and then was up 20. Okay? I think 23 is very doable for the consensus. But the catch is, and I ran the numbers, if we just get 23% earnings growth, that's not going to be enough to justify where the stock market is right now. We would need closer to 40% according to my calculations. Now, I didn't want to put that on here because I didn't want to bore you with all the math, but you can call me and I'd be glad to show that to you. But going from minus 25 to positive 40, now that hasn't really been done. The closest thing to that was maybe 2003 and recently with the great financial crisis, but we had much worse earnings prior to that. And so that means that the comparables were a lot easier. The comparables this time are going to be not quite as easy to beat, is my point. And so that's what makes me a little bit skeptical that to get to 40, it's possible, but it's going to be pretty hard because of how expensive the stock market's gotten recently. Make sense? Now in the market outlook, I talked about the great rotation happening. So I wanted to show you some of these slides, illustrations that kind of back that up a little bit. And I'm going to end with these last two slides here. So first of all, growth versus value. On the left here, you could see the ratio between growth and value stocks. And this last peak here was back when the tech bubble burst. And so basically, and this goes through like the middle of May, it's actually gotten a little worse. But we're basically at a point where growth stocks are more expensive than they have been ever. More than during the tech bubble. Okay? So maybe a little bit of a valuation, maybe a change from value to growth is happening. The other thing here is growth stocks carry the highest implied equity duration. Okay, duration is interest rate sensitivity. So if interest rates are going up, and we've started to see a little bit of that because growth is starting to improve, and when growth goes up, interest rates go up. And so growth stocks have the most sensitivity to interest rates going up, and it's in a negative way. So when interest rates go up, their values go down. And you can see how value stocks have much lower sensitivity to interest rates than growth stocks. So a couple pretty compelling reasons why we might start seeing value outperform growth. Okay, my last slide here. International stocks outperformance? Question mark. I've been talking about this a lot. And in the outlook, I mentioned a few of the potential catalysts of why this is happening. But this chart here is potentially another catalyst. What you can see here is on the top of the chart, it shows when domestic stocks have outperformed international stocks. So of course the bottom is when international has done better. And what you can see here is that usually U.S. outperforms on average about 6-7 years at a time. We are at a point where U.S. stocks have outperformed 9.6 years now. And with trade maybe getting a little easier with the Biden administration, the dollar weakening because of all the stimulus, international might be a good investment going forward, especially as also international stocks tend to have more cyclical stocks in them, which as you heard me talk about, could also start doing better as the economy improves. And so I think that there is a possibility for international stocks to start doing better than the domestic stocks. And this is just another little factoid there. Thanks.